JNK India, the company listed back in April and since then has shown strong growth. The company primarily generates revenue from sale of fired heaters and related products and recorded a revenue jump of nearly 140% in Q1. My colleague Anushi spoke to Arvind Kamath, who is the chairman and whole-time director at JNK India, and Praveen Sathe, who is the chief financial officer at JNK India, about what has been driving this growth. Listen in.
It's been a fantastic Q1 and H1 for us in this year. I mean, we got listed in the Q1, and actually the listing and the proceedings from the primary objects really helped us a lot in getting the larger contracts which we expected. So the order inflow for this till end of August has been almost 900 crores, and our order backlog from, as you said, which was around 620-630 crores in end of March, has moved to around 1450 crores is on end of August. So that gives us a very good visibility for this year, not only growth in this year, also in the next year. Also the sectors, as you know, the petrochemical and the refining sector is doing quite well now, and we also have a good visibility in terms of the big pipeline for next 3 to 4 years.
All right, that's fair to understand. Mr. Sathe, coming to you now, you've raised about 300 crore through the primary market. Want to understand what's the update? Have you started deploying the funds? Are you seeing an improvement in the working capital as we speak?
Yes, the basic purpose of the IPO was to cater to the working capital. So we have deployed the funds in the working capital, and few of the funds are parked as deposits, which are towards the margin money for the bank guarantee requirements that we have.
Okay, and Mr. Sathe, staying with you for the next question on the margin profile, I want to understand. Now, if you look at Q1, there was a kind of hit that we looked at in the margin terms, 21% of margins, that had skidded down to about 11%. Wanted to understand if there was any one-offs that we had seen in the quarter, and going forward, you maintain the 18% of the EBITDA range that you've historically maintained over the years.
Yeah, definitely. We have given a guidance of 18% of EBITDA to the market since the beginning, and it has been consistently maintained for last 3 to 4 years. Now, if we analyze quarter on quarter, the margins may vary, but on year-to-year basis, if we see, definitely there would be an improvement. But we can give minimum guidance of 18% of EBITDA and 11% of PAT.
Okay, so 18% of a guidance that we should continue to look forward for the business as we go forward. Mr. Kamath, coming to you, you have some strong diversification plans for the business. Now the core remains on the heating equipment, but you've also foraying into another space, which is waste gas handling, and this pertains to flares and incinerators along with renewable energy as we speak. I want to understand from you, what are the key growth drivers for which you are making this sort of a diversification, and what is the plan ahead for these two segments?
Yeah, thank you, Anushi, for asking this question. That's a very relevant question for us because not only heating equipment, which has been our core business for last few years, but we forayed into waste gas handling. And as we speak, in the first quarter, we have received 2 orders from IOCL for the waste gas handling project itself, which is a very prestigious and very important for us in this financial year, which we could get into, because we build our capability and expertise in this segment. And also in the heating equipment segment, I would like to mention that the Reliance order which we have received is for a cracking furnace, which is the kind of a first large contract on JNK India directly for the cracking furnace opportunities, because there are many petrochemical projects are announced in India. So most of the petrochemical projects would have cracking furnaces as a part of the cracker plant which is coming up. And as far as the renewable segment is concerned, we just heard that it's going a bit slow, but we have in big pipeline few of the opportunities. And as the segment grows, we are confident that we'll be also getting some orders in the renewable segment as well. As of now, trying to build the expertise and experience on the renewable segment.
Mr. Kamath, you mentioned about the Reliance order and or securing orders from IOCL also. I want to understand the timeline of these two orders. When should these be executed by? And also on your overall order book also that you've mentioned, the 1,400 crore, even on a historic basis, what is the kind of execution timeline that the company sees for its order book?
Yeah, I mean, generally the execution period for most of our contracts varies from around 1 year to 2 years. So like the IOCL orders, which is for incinerators, that is around 1 year execution period. And Reliance, which is a large contract for cracking furnace, it is about 21 to 22 months execution period. So that's the kind of execution period which we have. Most of the contracts ranges from 1 to 2 years.
Okay, so 1 to 2 years is the contract range that you have for your overall order book. Now, coming to the mix of the segments that you've mentioned and are diversifying into, if you look at the order book mix, 5% was what it made for the flares and incinerators. What is the type of mix in the next 3 to 4 years that we plan to have? Where do we see, what is the kind of revenue mix that we plan to generate from the two segments that you're expanding into?
Basically, as far as the waste gas handling segment is concerned, currently in the order inflow, it is about 12% is the waste gas handling segment. So, we are expecting it to be anywhere between 10 to 15% of our total order book would be the waste gas handling. And as far as the renewable segment is concerned, that could be around, say, 5% in terms of the order book this year. But going ahead, we plan to build up around 10% of our total revenues in next 2 to 3 years.
All right, 10 to 15 from the waste gas handling and the other around 10% that we are seeing going forward. Coming to the margins, I want to understand from you, Mr. Sathe, now 18% of a guidance that you've given. Do we expect any kind of shift with these two segments gaining more traction, their contribution increasing going forward? What are the type of margins if you want to break it segment in a segment manner compared to your heating equipment?
Yeah, Rishi. See, the margin profile is different for different projects, but on an average, if you see, we make up that 18%. So few projects wherein we have to strategically get an entry or we are relatively new, there the margin profile would be a little on the lesser side, but few projects we may make margins of 23, 24% also. So on an average, if you see, even if we enter into these new segments, we are confident that we'll be maintaining the EBITDA level of 18%.
Okay, so 18% EBITDA level stays for future as well. Now coming to the order bidding opportunity that you've mentioned in your previous conference call, that stood at about 4,000 crore, and this is with a success ratio of about 20 to 25%. Mr. Kamath, I want to come to you on this one. Where do we see more of these orders coming in from? And also if you can break it down on a geographic basis, in which geographies are we seeing more orders internationally?
I mean, the bid pipeline is we still around that figure, what we mentioned earlier. Though we had an order inflow of around 900 crores till end of August, Anushi. In terms of the geography, there is about 50% from the India, because India still has a lot of opportunities in these sectors, and the balance 50% is from the export opportunities, where it is mainly Middle East, Africa, and Eastern Europe countries.
Okay, and going forward, what is the kind of mix that we want to maintain in terms of geographies?
It depends on the type of opportunities, because we cautiously ensure that we get a good opportunity which is technically more better for us to build the expertise, and also commercially better in terms of the payment terms, cash flows, and things like that. So that's how difficult to exactly say the mix what we would have. Historically, we had a mix of about 50-60% exports and about 40% domestic. But going ahead, it could be around 50-50 or thereabouts.
All right, that's fair. So 50-50 mix that we should be looking out for. Mr. Sathe, my final question to you is, on a 3-year basis, if you were to look at your capex plans, can you highlight what are your capex plans currently and what do you expect them to be in future?
We don't have major capex plans in the next 3 years or so, because we have our manufacturing facility at Mundra in SEZ. There would be little bit expenses to modernize and to enhance our modularization capabilities, but they would be not to a large extent. So at least for the next 3 years, we don't see much capex.
Okay, so no major capex requirements in a 3-year perspective. Well, that was my final question. Thank you, Mr. Kamath. Thank you, Mr. Satya, for joining into NDTV Profit and sharing your outlook on the company's prospects forward.
Thank you, Rishi. Thank you so much.
Well, that was the management of JNK India talking to us, extensively about what the outlook for the company is. But with that, it's a wrap on the small and mid cap show. But keep watching NDTV Profit. More on the other side.